Hi, I'm Ankur Kapoor. In this video, we'll be discussing about the techniques we need to use to identify quality companies. Yes, I'll link it with the startup investing as well. So let's get started. In the recent past, a lot of my investors have approached me and asked me why we are not investing in startups. Since they are all over the place, all the newspapers are filled with startup funding and all. So let's talk a bit about startup investing. Well, first of all, I'm not at all against startup investing. I just feel that it's not a play for everyone. It is a play for people who already have a lot of money and who can afford to lose some bit of money, because it's not necessary that all startups will work out. Well, startup investing and the numbers that you see in the newspaper are actually numbers that fluctuate quite a bit, as well as it is based on the recent funding round. Just imagine you're selling 5% stake of your company for say 1 lakh rupee. So the valuation of that company would be, so the whole company is worth 20 lakhs. But that's not how practically valuation works. It is more of, in a private startup space, this valuation is quoted, and somewhere journalists are so happy about quoting these absurd numbers, and often lay people do get trapped in this kind of language. So rules of valuations have not changed. All these years rules have been the same. That is, whatever is the cash flow of the company, you discount it in today's value should be the value of the company. No one has ever been able to change this rule, whether it was 100 years back, 50 years back, or even now. So now with startup investing, there is no cash flow, because often these are loss-making entities, so there is no cash they are generating. But still we assign a number to that. I'm not saying that number will not translate to any real value. It may or it may not. But for sure, majority of startups will not survive. That is not my expectation, or that is not my wish, or that is not my opinion. It is a factual thing that businesses at a nascent stage do not survive, and there is a point in time they die. And so will these startups, because there are two nuances to it. If the startup is just a loss incurring version of things, no competition will come in because they don't see any cash flow. But in case the startup is cash flow generating, then there will be competition, and that will take away the profit of this company. Very few will survive in such a way that the competition is not able to take away their advantage, whatever that advantage proposition is. In business language, we call it competitive advantage. It varies from companies to company. So you need to really get into the business understanding why a company is able to retain market share and no other competitor is able to enter. For example, Asian Paints is such an old company. They still hold 60% market share. Why can't any other player enter? There is a competitive advantage that Asian Paints has, and not other companies can copy that. So often I have mentioned about the cash flows. What are these cash flows? How do companies generate cash flows? In simple terms, if you have 100 rupees and if you make 10 rupees on that 10 rupees is the cash flow. And it's not a rocket science to understand that if you have 100 rupees and if you spend 10 rupees and if you're left with 90, there is a negative cash flow or a negative profit, which is called losses, right? So you are actually paying out of capital, and there would be one point in time you don't have any money to pay. So you're bankrupt at that point in time. So let's talk about the positive cash flows. Positive cash flow is where wealth is generated. So our idea of investing in companies is primarily linked with investing in those businesses that are cash making machines. I'm using these words very seriously and practically. Cash making machines. So let me just show this example what I'm talking about, why I'm saying a company's cash making machine, and not a lot of companies are in that category. So let's look at this example. So this is a company, Paytm, quite popular company in India. Recently had their IPO and it was criticized quite a bit. I think it was around 1800 and the current price is floating around 500. Instead of just looking at these numbers on the share price, let's look at the cash flows here. Although it's a short history of this company, but let's look at the cash flows. Simply speaking, a cash flow or free cash flow, something that a company is left with after meeting its requirement, broadly is cash from its operations, this number plus whatever they are spending on fixed assets purchases. So you can very well see that it's all through negative number, and there is obviously when you're spending, it's a negative number, so the total is a massive negative number. It started with almost 1800 rupees and it is down to 540, and probably it's the lowest point here. It's going further down. Let's look at another company, say Nestle. So everyone knows Nestle brand, it's a consumer brand. They have been in India for many decades now. So let's look at the cash flow section here. Look at 2020-200. Just note it's not a negative number, it's a positive number. Even if you deduct 700 crores for expenses, you're left with 1500 crores of cash flows. Similarly, for 2020, the net would be around 1900 cash flows, and so on. Historically, you can see the company has always been profitable and cash flow generating machine. Let's look at the price. Almost 4x the number right now in 10 years, which basically means around 14% return year on year. So any company that is not generating cash will see a graph similar to what you saw in Paytm, that is decline, or flat. If it is already declined, it will not fall further, but there is no return. Any company that is a cash making machine will see returns going up, and usually the return of stock will be similar to the cash flow generation capacity of a company. So let's say this free cash flow is growing at a rate of 15%. 5 years down the line, more often than not, the returns would be 15% per annum at the share price level also. So how do you see that which all companies are great companies to hold in Indian context? So one of the ways to look at is companies that are generating profitability. You can look at that through return on capital employed. Higher the better, but it should be at least 15%. Companies with minimal debt or zero debt. And third is where the cash flow growth is at least beating inflation. Higher the better. What I'm saying, beating the inflation in nominal terms, we are saying at least 7-8% plus kind of growth. So one of the ways to apply this, since free cash flow number you need to calculate, a proxy of that would be using sales number, let's say a sales growth of 7% per year. Apply this over a 5-year period and you will know which all companies to look at. So what I'm saying is, let's say market cap of 100 crore plus. We want return on capital employed to be more than 15%. Debt to equity ratio, minimal is better. Let's keep it 0.5 actually. I'm just using average for 3 years, also 15%. and now the sales growth of more than 7%. So here you see, when we click on this, you just get 172 companies out of the entire list of almost 6,000 plus companies listed in India that qualify our basic criteria. After doing all the analysis, you have to boil down to a very manageable number of companies. These companies would often be in the range of 40-50 companies, maybe 60 companies. After identifying these companies, we have to do a whole lot of analysis, whether it qualifies in terms of quality of earnings, whether it qualifies as a quality of corporate governance. We have to look at the management quality. We have to look at a competitive edge of the company, sustainability of the company, longevity of the company. So this is only filtering of companies, and you boil down to those manageable names. And now, after the analysis, you will further refine and it will further reduce the number of companies. I will end this video with a very popular saying that Warren Buffett said in 99, when the tech bubble was happening during that time, that there is a concept of wealth transfer and there is a concept of wealth creation. A lot of startup funding and all those things are a form of wealth transfer. Promoter getting rich, investor getting poor. Similarly, when a company is a cash generating machine, it creates wealth for everyone. Investors, promoters, employees, stakeholders, everyone makes money investing or being associated with these set of companies. My experience says that it is better to be associated with quality companies, franchisees. The focus is primarily on these companies being able to generate wealth over a sustained period of time and the focus with which they generate. So there are financial analysis tools to do that, and there are other qualitative assessments that you have to do. But for now, just one point that I will make is focus on free cash flow generating potential of companies and not the fad of what people are talking about. This will become great and this will become this. That may or may not happen. And it's a hard-earned money. You don't want to lose it. Thank you for watching.